let's dig into the first real deal. So let's talk about this. These unicorns, Paul, these companies that have these crazy valuations. Now, a couple of months ago, Mark Cuban kind of warned about these things because it's getting nuts. I mean, we talk about how nuts, we try to compare what's going on in the market now to the bubble. There's really no real comparison, but when you take stocks that aren't publicly traded and they have these $40 billion market valuations, people wonder.
Mark who? This is nothing like 2000. The public is anything
but I'm not talking about the publicly traded stuff. What about this stuff that's not public? Every day, one of these companies gets another billion-dollar valuation, and a lot of them don't have profits.
You can't compare a billion-dollar valuation to valuations in the past. This is a different kind of market. Let me say this. The public's only going to buy, when they go public, the largest and brightest names, the Snapchats, the Ubers.
But a lot of people are down already on Etsy. They're getting crushed.
I don't think the average individual is trading these tech IPOs. I think this is mostly institutional market. This is not like Pets.com, TheGlobe.com, DRCoop.com. This is a different kind of market. But if there's any kind of froth, maybe I'll give you, it's in those kind of names, the private ones. When they go public, mom and dad are not jumping in.
Well, I hope they're not jumping in. Listen, they didn't buy Candy Crush. They were smart enough to know that kind of stuff was a fad. But maybe, listen.
They didn't buy Alibaba?
I think they bought Etsy, though. I think a lot of regular users of Etsy probably said, hey, it's public, I'll buy it. But here's the thing. And it's part of the system, right? I guess these guys are comfortable with sucking up all the valuation, let's say, off the market, taking these companies from $1 billion to $40 billion in valuations. I think there's something inherently wrong with this, Hillary, when you go public and then, the public has to pay these exorbitant prices for these shares.
Well, I agree, and it's almost as if there's a game going on. So the game is, let's keep doing these additional rounds of funding. Everyone who's on the inside, mainly Silicon Valley, and of course private equity and venture capital outside of Silicon Valley, they all kind of jump in, and then us as investors, the individual investor, they have to pay the price because their chance to get in is the time that the cash out, maybe 6 months later.
They don't have to pay the price. That's their option because, yes, a $40 billion valuation, somebody put money in that $40 billion. And then it goes public, it runs up to $60 billion. We don't have to pay the price. I mean, we always talk about invest in what you know, right? People know Etsy, and I can see why they want to buy that. But you also have to do your homework and look at Etsy, whatever valuation isn't attractive at this level. It was a year and a half ago, and VC put money in.
Ordinarily, I would agree, but individual investors, they are inundated with the hype. It comes from the media, it comes from social media, and so often they're not really able to differentiate, and that's why they got.
But they learned the hard way in 2000. They learned. They're still scarred from 2000.
No, I don't think
I
think there's still a lot of the wanting to get the big hit. I mean, if you'd invested in Amazon, when they went to their IPO, you'd have a 200 times return. So there's a little bit of that, but it's also the emotional. Etsy, I mean, like you said, the users, they love it. If Uber goes public, there are people who are big fans of Uber, but they don't have the skills.
Uber will have a lot of people lined up to buy that stock when they go public, no matter what the price is. No matter what the share price is or the valuation. Because I guarantee you 80% of Main Street that buys it won't even know what valuation is anyway, Lauren.
I mean, that's the thing. These are young companies. They have new, innovative business models. It's hard to figure out exactly what the valuation is. And the average consumer who's getting into this stock really has no clue what they're doing. So it's a lot of risk, and they're not necessarily taking that into consideration.
Although, the same token, Facebook was an unmitigated disaster. If someone wrote it out, though, after it crashed after the IPO, they'd be very happy. I want to find out, before we switch subtopics, guys, though, are these unicorns a red flag? Now, we got your opinion on this, Paul. Are these unicorns a red flag, though, for the broader market? Do they say, hey, get out? Or is it just a unique situation that's developed on its own? And listen, it's billionaires. They've got, who cares about their problems, right?
Right. And quantitative easing has brought interest rates down to 0%. As long as we're there, these are going to continue and keep rolling out until rates go up. So everyone should beware. And if you want to buy an IPO, buy a biotech that makes some sense, or buy a yield plan.
Well, most of those ain't making no money.
I also think that if you're going to buy one of these stocks, it's got to be money that you can afford to lose, at least initially. So it's not that you're making this for a long-term investment. This is
I wouldn't say lose, but save money that you could afford to be down on. It's like if you open a pizzeria tomorrow in New York City and you had to sell it 2 days later, you probably get half the money you put into it.
But buying at the offering, buying at the IPO is crazy. Let it shake out for several months. I'd rather pay a little bit higher than watch something like an Etsy or LinkedIn or something else like that.
I think we all agree that the risk right now for these unicorns are too much for the average person to buy them on the IPO day. Beware. All right, by the way,